Hey everybody, just a very small note before we begin this episode. Our guest Jeff has shared with us a few slides that will help you navigate through the episode. It is not mandatory at all, you can listen to the episode and still get everything, but if you want to go deeper and have a visual support, head to corporate-treasury-101.com, head to the article section and look for the one with Jeff to download the slides for free. The link is of course in the description to make it easier. Enjoy the episode.
Welcome to the Corporate Treasury 101 podcast. This is the third and last part of our full interview with Jeff Goggins, where we discuss FX risk hedging and AI in financial risk management. Jeff is a director at Kyriba, part of the advisory team, and focuses on FX risk management. Kyriba's treasury management system is a well-known solution providing automated cash management, bank connectivity, liquidity planning, payments, working capital, and many other features. In the episode of today, expect to learn how to hedge against the different types of FX risk, how should companies manage their hedging strategies, what is the difference between central and local management of FX risk, how is AI impacting FX risk management, and, like always, very much more. We hope you will enjoy the episode. If that is the case, and when you're thinking about how you found our podcast, chances are that it was through word of mouth, social medias, or a recommendation from your favorite podcast platform. And this is our ask to you. The only way the podcast can grow and for more people to learn about Treasury is thanks to you. So if you enjoy what you hear, learn something, please consider following the show, leaving us a review, and sharing this episode to help others discover it too. Also, if you're eager to explore how AI is revolutionizing our industry, be sure to join our bi-weekly newsletter, AI Treasury Insights. Check out the link in the description or head straight to corporate-treasury-101.com/newsletter. With all that being said, please welcome Jeff Goggins. So how about we go back to, I love that you touched upon a hedge accounting. That's a whole other animal, as you call them. But maybe before that, can you explain us how those companies would hedge against all those risks? Like maybe not going into all the details of transaction risk, anticipated transaction risk booked and so on, but overall, how should a board and the different stakeholders we touched upon earlier should look at this risk and hedge against them?
Well, at a very high level, what you're trying to do is, it's at the point in time you think you have a risk and you would like to lock in to a certain value of that transaction, eliminate the foreign currency element volatility out of that transaction. And the simplest thing that you're doing is you're calling the bank. Most companies are using very basic forward contracts where you're locking in. Instead of doing a spot contract where you're just converting, let's say, the currency right away, you're locking into a rate and it will have something called forward points, and you're locking into a future date delivery of that contract. And so let's say you have euro revenue next month and you like the rate today. I think the euro's been doing okay lately. It's like 108, 109. You're like, okay, that's good. It could go up, it could go down, but I just want to lock it in today. So you call the bank, it's euro revenue. So you would say your long revenue. And you can call the bank and say, hey, I want to sell X amount of euros for delivery next month. And so they give you a rate and you've essentially locked that in then. So whether you take delivery of the contract, so whether you actually collect those euros and then you sell the euros to the bank, you wire the bank the euros, or you can do something at the end if you don't actually want to do that actual delivery. You can actually just kind of close out the contract at the end at the new market rates a month from now. So economically, what you've done though is you've put a short euro position, on your books or to offset that long euro revenue. And you could do that with the forward contracts. Global companies might do that with an option contract. And, sometimes you see some collars. A lot of times, though, in the FX world for global companies, they're doing pretty basic things with the instruments and hedging. So that's kind of the basic gist of all you're doing is working with the bank to put that offsetting position on your books. And with that comes, a whole slew of challenges, understanding what's going on, getting the information, getting to that point where you know what you want to tell the bank what to do, and then accounting and tracking everything. But that's what they're doing.
I'm guessing there's not like a one-size-fits-all solution to each transaction, right? It's interesting you mentioned you can either not exercise that option with the bank or choose to exercise it, and there's different strategies later. What are like the different parameters, I guess, that change from a hedge to hedge? It's like period that you're hedging out from, or how long ahead you're hedging, I guess. What else like changes between different hedges itself?
Well, it's a good question.
Do you hedge the entire amount always? Or can you also do a partial hedge because it's cheaper? Or like, I guess there's differences like this, right?
Yeah, I'm trying to think of how to go in this direction without getting insanely detailed.
Go for it. But don't be afraid of details. We'll love technical details here, Jeff. It's all good.
So we talked about kind of when your risk starts. So that's the one variable is, deciding when you're going to actually start putting the hedges in place. But then, as you said, so what are your variables for kind of how to end the hedging and things like that? And the difficult thing with answering that question is just that so many companies are doing so many things differently, and you can get some different instruments involved as well. But generally speaking, if we're talking about hedge accounting, the one thing companies don't want to do is risk losing hedge accounting. So a lot of times they'll structure a hedge program so that you've probably heard of the term layering. So they're doing some form of layering their hedges. So if they're hedging something that's 8 months from now, they don't want to just jump out and hedge that 100%. Because what if the forecast changes? What if the forecast comes back a little different? So depending on the company, depending on, the reliability of whatever particular item that they're hedging and business flow that they're hedging, they're going to decide, well, maybe we'll have a program where we start off hedging 20%. In 3 months, we get a kind of a fresh forecast. We're now a little bit closer to that time frame where it's going to occur. We feel more comfortable. We'll add another 20% to our hedge. And then 3 months go by. We're even more confident now. We're going to add another 20% to our hedge position. So companies will do certain strategies based on pretty much their comfort level with being wrong and the comfort level with the forecast. So some companies will say, you know what, we really can't even have any reliability on a monthly forecast, but we feel pretty good about our quarterly forecast. So we know that we'll have a certain amount of sales within this quarter. Not sure if it'll be next January, February, or March, but it's going to be flowing in that quarter. So you can actually kind of view yourself as hedging for the quarter. And then you have decisions to make where I could have my hedge mature at the end of the quarter, and then I can kind of unwind it as each month goes by and I kind of know what's come in. I can kind of economically unwind my hedge as I go. Or, maybe you do something else or have it just mature in the middle of the quarter. So those are all decisions that a company kind of needs to walk through when they're setting up their hedge program and figuring out how they want to actually structure, all of that administrative parts of the hedging process.
And am I right in saying you only hedge, maybe I'm saying something stupid here, you only hedge the booked risk against your booked FX risk? Because we talked about the different types of FX risk, right? Mm-hmm. I guess you don't hedge your anticipated Or do you hedge the difference between anticipated and booked? Like which one of the risks are you hedging?
Yeah, the tough thing with a podcast here is I don't have my PowerPoint slides to show you, but I like to lay that out on a timeline, and so you can hedge both.
Okay.
Now with a public company, that's why they want hedge accounting, because what hedge accounting does is it allows them to hedge the anticipated risk without there being this big accounting mismatch with what they have to book for the hedging contract and what they are not booking for the risk, because it's an anticipated risk. It's not on your books. So with hedge accounting, basically what it allows you to do under IFRS 9 and US GAAP ASC 815 is what it's allowing companies to do is it's allowing them to put this derivative on their books, but they're basically allowed to, I'll call it hiding, but it's not hiding, it's legitimate, but it's hiding it from the P&L because it allows them to put the hedge result into something called other comprehensive income, OCI, which is in equity. And so only at the end of the hedge, you do everything properly. At the end of the hedge is when you will then book the result of the hedge in the P&L. And if you're hedging revenue, then what you want to do is then, okay, my hedge result is going into revenue. So in that Japanese yen example, you would be able to basically tuck away the hedge result until the very end when you had those losses because on your revenue, losses on your anticipated value of your Japanese yen revenue. So if your Japanese yen revenue you were hoping was 500 million, it's now only worth 400 million. Well, what happens there at the end is you get to say, okay, I had my hedge result of 100 million positive. I can now book that into revenue, and I have my revenue of 500 million. So everything works out how I want it at the end. So that's hedging the anticipated risk. Is a lot of companies, especially public companies, will want to use hedge accounting to be able to make the accounting line up with that economic risk that they're hedging or anticipated risk that they're hedging. On the book transaction, you actually are okay with, you have a hedge, you have to mark to market that hedge, you have to book it at the fair value at the end of each month. And the whole idea is, okay, I'm okay with that hedge being booked to FX gain or loss on my P&L, because that's going to offset, if I did everything correctly, that's going to offset that revaluation of the booked risk that's also impacting the FX gain or loss in the opposite direction. So you want to approach those with kind of a different strategy, but you can hedge them both.
Jeff, maybe, so I feel we've touched upon quite some throughout this episode, but can you highlight and maybe summarize what are the biggest challenges when it comes to FX risk management and hedging and hedge accounting, and making the link maybe with recent events and period we are in, like how those high volatility periods impacts all this risk management, and overall, is it the biggest challenge or are there others? What's your view on that?
Yeah, sure. I'll answer the second question first. So yeah, there has been a lot of volatility over the past year, especially the past couple of years. A lot of people, attribute to the central banks being a lot more active now. They're changing their rates more. There seems to be a lot more fluctuations that ends up driving with central bank interventions. It kind of has more unexpected changes to both the currency values, as well as it's been making the cost of hedging a little bit more volatile. So when I mentioned like a simple example with a forward contract of hedging, there's a component of that in the forward points that's actually based on interest rate differentials between both currencies. So as the central banks are kind of, raising their interest rates up and down, and there's just more action there, that's also just changing, the way companies are seeing their cost of hedging kind of flow through. So all that volatility has really thrown a lot of companies off. Even companies that have had hedge programs, they're seeing like all of a sudden their cost of hedging is way different and they might want to approach things differently. And the way that I think volatility impacts companies the most is really just, especially companies that have hedge programs. So little things that maybe were off in your hedge program. So let's say you're relying on forecasts and the forecasts have been off, but the rates haven't really moved that much. Well, if rates aren't moving a lot and your hedge program isn't perfect, you're not going to notice a big difference because, you're not going to be getting hit hard by some small mistakes. But when volatility is high, you can have smaller mistakes that actually kind of hit you hard and kind of come to the surface. So it really, I think, exposes a lot of issues that companies have had underlying to their FX risk and their hedge programs. It's really just exposing things that otherwise could have been kind of swept under the rug. So, at a high level, I think that's where the volatility's surfacing is just, it's exposing issues that have been around for a while that companies have been able to get away with not addressing. And then the biggest challenge, I think, just in general, again, we talked about FX being this kind of circular, iterative learning process. There's a lot of concepts. There's a lot of differences in terminology. There's a lot of complexities with the way global companies are set up. And as a practitioner, I've worked with practitioners before who they came from one company who kind of had a certain functional currency set up, or they booked transactions a certain way and kind of thought they knew what was going on. They get to a new company who is booking the transactions completely differently. They have a different functional currency setup, different type of flows, and the hedge program is completely different. The approach to it is different. So there's always a lot to learn. There's always a challenge with just knowing the landscape of what's going on. But then in addition to that, we didn't touch on it a lot, but is just then getting the information, the administrative process of getting visibility on your exposures. Historically, ERP systems haven't had a lot of great direct reporting that will give you kind of those non-functional currency balances right out of the ERP. But you've got to take all this information, you got to aggregate it, you got to analyze it, and then you got to make actions on it. It's a big administrative process and it's a big learning process, but that's what I find really great about FX is there's just constantly something to learn. When I went from being a corporate treasury practitioner to the consulting side 7 years ago, when I was interviewing, for that consulting company, one of their concerns was, as an assistant treasurer, you're just wearing all these hats. You're focused on the global cash management, the debt, the FX is just one piece of it. You're even involved in insurance, and like, how are you going to handle, just focusing on FX? And, I said, well, to be honest, I wasn't sure, but I said, I think that I really like diving into the technical side of things. FX is actually a really big world. And that turned out to be absolutely true. Like, the more you learn, the more you realize you don't know. And there's just tons to learn in FX. So it's a challenge, but it makes it really interesting.
No, definitely getting that impression. Jeff, didn't think we'd have so much, but so much we haven't talked about. But we're closing in on the end of the episode now. But thank you so much. So I feel like we've got a much better idea of different types of FX risk, and then the human element of that and the expectation and how you can set up, how different companies are set up differently in terms of where they need to report and how that affects their hedging strategies and how that affects what a risk is, and so much more we haven't covered yet. But thank you so much for also taking us through all of that. Last question for you, Jeff, something you were starting to wrap up the episodes with. In today's world, AI is all the buzz. Treasury is not immune to that at all. What's your opinions on how AI is going to affect FX, risk management, hedging, etc.? Like, where do you see the biggest opportunities for AI in this space?
Yeah, so I'm sure there's just endless possibilities with where AI is going and how it can help FX. The first thing that comes to mind is that forecasting piece. So exposure forecasting, whether you're talking about, so let's just focus more on the transactional risk, on any elements of that. Certain companies need to employ certain types of forecasting potentially to understand the exposure, and that can be a challenge for folks. So I would imagine with similar to cash forecasting, using machine learning, using AI to help that forecasting is going to be great for FX, because at the end of the day, it's just like a lot of other things. It's garbage in, garbage out. If you're hedging the wrong exposure or an inaccurate exposure, you're not going to be very effective economically with your hedge program. And so if AI can help with that, that'll be huge. I'd imagine that AI could eventually kind of swoop in, maybe on more the execution side of things, maybe automate how companies are executing their FX deals, and in a way that can get them a good deal, with the bank, but automate it for them. So right now there's decent automation with companies using multi-bank trade portals, but if that could be even streamlined further, all those administrative processes, will be great for automation.
Super cool. Thanks so much, Jeff. So anything else we haven't touched on in FX risk management that you'd like to just leave a quick note on to end for our listeners?
No, I think, if I guess this is Treasury 101, so everyone's learning. I'm realizing that I usually have PowerPoint slides in front of me when I'm doing like an FX training on these concepts. And as a podcast, I'm a little worried that, that was maybe a little hard to follow without materials, but there are materials out there available. You can look at my company's website, just seek them out, whether it's, your local treasury group or whatnot. Go through them. I think it's, it'll help out a lot to maybe see some of these concepts laid out, some timelines laid out, but, don't, especially when you start getting into hedge accounting, don't get frustrated. It's a lot of going around in circles, chasing concepts down, kind of reevaluating, what you just read. So if it didn't all make sense, just stick with it. Keep learning, and it'll all make sense in the end.